MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, here we are. Good to be with you, Jim.
Well, right here, live and in living color, we're watching a trade war unveil itself, with Donald Trump wanting to add another $100 billion in tariffs against China, and the Chinese government announcing very shortly that it's going to do everything to do whatever it has to do to win this trade war.
Yep, well, that is the Chinese government acting rather childishly, sort of a tit-for-tat response, and the media are full of stories about Trump's protectionism, but what I view it as is that these big countries like China, they have been running a protectionism against the U.S. in preventing products from getting in, and, taxes and all that sort of stuff. So it's been sort of a one-way street. And then, of course, with trade between Canada and the U.S. and Mexico and U.S. under the previous NAFTA agreement, which was 25 years ago, that it was designed, and they, bureaucrats, designed the thing, and what they did is allowed Canada to cheat. And the cheat is, of course, depreciating the currency relative to the U.S. dollar. And at one time, the Canadian dollar traded at par with the U.S. in the earlier days of NAFTA, and then it slipped down to 63 cents. Now it's sort of around 78 cents. So you've got that cheat. And, of course, the Mexicans, some time ago, depreciated their currency. So the U.S. has not been on the right side of the deal. And I always say to people who get all enraptured about free trade, go ahead and do it. Declare free trade, no tariffs, no regulations, nothing in any direction, and see what happens. And there would be things being disturbed initially, but eventually, if you've got a free trade economy, you're just going to rise to the top. It'd be fabulous. But in the meantime, these I'd call them gestures and responses from China, for example, are really infantile. And but what is going to happen is, looking ahead, is we're in a boom now. You've got headlines about heavy truck sales are at records, and unemployment is low, and it's a boom going on out there. And the financial markets have been in a great bubble. So somewhere there will be a recession. Now, and if you take history, it is during the recession when each country is facing, ranks of unemployed people and hardship and all that sort of stuff. Now, then that's when the politicians in each country really get provoked or motivated to come in with protectionist measures. So this is a little unusual, where in a boom they're talking protection, but what it is Trump trying to make, reduce China's protectionism, for example. So, and of course the media is going on about it, because nobody in the media likes Trump or the reform movement that's going on out there with things. So, but it's fascinating to watch. And but as to when the recession starts, we don't know that yet, But all you know is that when you're in this strong a boom, you can't run this kind of intensity forever. So what we're doing, of course, is watching the credit markets. You watch the credit spreads, which is the difference between high-grade bonds and low-grade bonds. And in good times, those spreads narrow, and spreads are not as narrow as they have been, but they're not flashing any urgent warnings here now. And then the other one we look at is the difference on the yield curve, which is from short-dated to long-dated government bonds. And the curve it's flattening, and who knows whether it gets inverted or not, because the demand for short-term funds for speculation drives treasury bills up. And then as that gets intense, the short rates go up faster than long rates, and the curve is flattening. So long as the curve is flattening or heading towards inversion, that's part of a boom. So at the moment, the curve is not offering any warnings. It's just sort of out there doing what it's doing, and nothing alarming there at the moment. So but the financial markets will anticipate the next hit to the stock market, and that would be fairly close to the business activity slowing down rather quickly. When you're in a world of inflation in financial assets, the economy depends upon financial speculation, and then when financial speculation rolls over, it takes the economy with it. And there's some history to that which we can go over.
We'll have more from Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. Bob, what is the history when we see large increases in stock markets and financial assets? What's the consequence, and how frequently does this happen?
Yeah, well, it's always hard to say that something's normal, but back in history, through the 40s and 50s and 60s, even in the 70s, you'd have a bull market, and then it would go up and with certain excesses peak and then head down. But that was usually you had the peak of the stock market maybe 10 to 12 months before the economy actually peaked. So this used to provide some amusement because you would have the economy showing good signs. Oh, this is great stuff for fund managers. At the same time as the stock market was weakening, with using the senior indexes like the Dow or the TSE Industrials, and they'd be going down. But the fund managers and investors were feeling comfortable because the economy kept coming up with what was deemed good news, and then eventually the economy would head down, and then you ran into a world where fundamentalists would say, oh, right, okay, now we have a weak economy, I'll get out of the stock market. And then that went down to other phase of irony whereby the stock market started to bottom, and typically it would bottom maybe 6 to 8, maybe 10 months before the economy did. So then you had the savvy traders who were only looking at the stock market, forget about the economy. They were positioning on the long side, and then eventually the economy would turn up. So then your orthodox people, oh, this is great, we'll buy the stock market. So you have a bit in the middle there where you have the economy going up and the stock market going up at the same time. But at either end, it's perplexing for orthodoxy. So, but then, when you finally learn that, then when you get into a era of financial asset inflation where we have been in since the early 80s, then things begin to change. If you go back to the big bull market peak in 2007, it was signaled by changes in credit markets, and then the high was in October for the S&P, and then in December it was deemed, well, after December, but anyways, the recession was considered to have started in that December, so there was only a month and a half or 2 months difference between the top of a financial mania and the start of the recession. So if you go back to 1929, you had the high for the stock market in that fateful September, and the recession started in that equally fateful August. So, and this is determined by the NBER, which is the body that determines the business cycle. So, if you go back, and they worked out a business cycle all the way back to the 1850s. And then you had the big bubble in 1873, and the market peaked in New York in that fateful September. And using the NBER determination of the business cycle, the recession started that October, so within a month. So this, and actually we used this at the bottom in 2009, that once the stock market bottomed, which was in March, that the recovery would soon follow, and it was considered to start in June. So here we are. To make it clear, this has been a world of inflation in financial assets, and that in turn drives the economy. So whenever this stock market actually rolls over, the economy would be fairly close to following it, that. And this then, of course, makes for a very nasty experience, because all of a sudden you're gone from the heady world of both the economy and stocks going up to all of a sudden, oops, both of them are going down. So that is bound to happen mainly, Jim, because the speculative excesses in the stock market going into Christmas were so excessive. And then you had the hard hit. And then our view was sort of a cautious view that you might spend a good part of the first quarter trying to base the market using the senior indexes, not necessarily the speculative stocks. Well, it's been whipsaw city with up and then down. So when it's going up, all of a sudden there's lots of bullish conviction, and then it runs out of energy, and then it goes down. But recently here, this low in the last week has got some pretty good technical readings with it, and there's some probability that the general stock market could recover for, I wouldn't want to call it an intermediate rally, but it'll be a fairly good rally.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, cryptocurrencies have taken a huge dump. Is this just very typical of what you see, a huge rise in all kinds of speculation, and then the Grim Reaper comes in and starts swatting away?
You're Grim Reaper, indeed. There's, I would say that the price gains in the Bitcoin sector were extraordinary relative to other huge speculative surges. But these are, it's the public in action, it's crowd action, and the patterns recur. So what we were using in the summer, like we did a study in May, and you did a chart of perhaps say gold, and back in that huge bubble to January of 1980, or even the Nikkei to December of 89, and you get these swings from excess to correction and then back again. So in May, we did charts on that one showing where it lined up. I think it was about position 21 or something like that as it corrected to 23. And then it was showing that there was much more left on the upside. And then that was updated again in August. And then on October 4th, Pivot we published, that was last year, 2017, said that the bubble would continue and that even the Dow Jones would get bubbled. And that was a pretty bold statement because things were exceptionally high anyways. But anyways, that was the conclusion. And then that same October 4th report noted that when bubbles really do climax, it shakes the world. So noted that they run to disaster. And then in using that example of gold in 1980 and the Nikkei, they both climaxed right at the turn of the year. So we pointed this out and said that, if you have straight up going into January in these speculative sectors such as the Bitcoin, that would probably be the high. So our December 19th work on the Bitcoin registered what we call a sequential sell, which is a pattern analysis, and it hadn't done one of those in 2 years. So the conclusion was that the biggest correction in 2 years would follow, and it was instantaneous right then. And then the Pivot side on December 21st pointed out that in great speculations, the limiting factor has usually been, and the academics describe it as the cost of compounding interest rates. And then by this time it was in the media that just the cost of electricity in running computers' power to mine the Bitcoins was extraordinary. So you not only had the interest rate costs of being leveraged, you also had an enormous electrical power cost. So to keep servicing both those costs, you have to have the item of speculation continuing going straight up. So any break becomes nasty, and it was very hard break. And again, if you look at the charts of previous bubbles, when they've been hit hard and then bounce, there's kind of a recurring pattern there. So on the Bitcoin, there will be some attempts to rally. Maybe things might be positive into May for a lot of aspects of the equity markets. But our concerns, what would happen is after mid-year, when credit spreads could turn to adversity, and the same with the yield curve. So we'll be watching those things as we go along. But it is, Jim, I sort of thank things virtually every day for being alive and aware and watching. This is the greatest speculations in history. It's a privilege to be alive and watching this stuff. And then the second part is to be able to keep track of the swings and make the right calls on it.
Bob, thank you so much for talking with us.
Hey, it's a pleasure. We got another one done.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or the show, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.